everyone. I'm Katy Temple with ETF Guide. Thanks so much for joining us. If it's your first time watching, hit the subscribe button and post your comments below. We always enjoy interacting with our viewers. Okay, so how can you squeeze more income in a yield stingy market? The typical route is to focus on big companies and mature sectors. But on today's program, we're going to examine a new ETF that takes a different path by delivering a punch of income from mid and small company stocks. Here to join us today and talk about that and much more is Lance McGray, head of ETFs at Advisors Asset Management. Lance, thanks so much for stopping by. We're happy to have you.
Thanks for having me, Katy.
All right, let's get right to it. The AAM Bahl and Gaynor Small Mid-Cap Income Growth ETF, SMIG, is a newly launched fund that focuses on a segment of the stock market that's typically associated more often with growth investing than income investing. Tell us more about the fund's holdings and its approach.
Yeah, thanks a lot, Katy. You know, this is a strategy and a solution that we've been working on for the better part of 2 years now. And we are extremely excited about launching SMIG and the ability to combine the benefits of an accomplished active manager like Bahl and Gaynor with the benefits of the ETF Wrapper. You know, despite the popularity that we've seen in rules-based strategies and ETFs over the past year, what we found at AAM is that there really is a large population of advisors and investors who actually prefer actively managed funds over rules-based strategies for the obvious reasons. Right? And this is particularly true when we're looking at small and mid-cap stocks. You know, many believe this is an area where sound active management can really differentiate a portfolio and provide, additional benefit. And we tend to agree. You know, so as you mentioned, SMIG, SMIG is recently new to the market as of a few weeks ago. It's an actively managed ETF. And as such, it is really important to understand the underlying strategy and, more importantly, the manager behind the strategy. So let's touch briefly upon Bahl and Gaynor, who is the sub-advisor for our SMIG strategy. Bahl and Gaynor has been a trusted partner of AAM for many, many years. They are an employee-owned independent investment firm focused on high-quality dividend growth strategies. They're based in Cincinnati, Ohio, and as of 6/30, they had $46 billion under management. It's not ironic that they are guided by the philosophy that dividends pay dividends. And that's a great segue into sort of the SMIG strategy and really what we're trying to achieve with it. It's a relatively concentrated portfolio of 46 names, and it really has three main objectives. Number one is income generation. Number two is downside protection. And number three is we try to seek to provide strong total and risk-adjusted returns over a full market cycle. So getting back to your question, a lot of people think about small caps and mid caps to be growthy. But at AAM, we are all about income. And we know that income not only can help you achieve your cash flow needs, but also your long-term capital appreciation needs. And you don't necessarily just need to look at U.S. large caps or international large caps to achieve this income. You can dive down into the small cap and the mid cap arena and achieve very similar benefits that you would with large cap equities.
Okay, as highlighted, SMIG is an actively managed ETF. And for investors new to actively managed ETFs that offer full transparency, help us understand how it's different from the other actively managed products like mutual funds.
Yeah, this is a great point. And the one thing that you need to think about and keep in mind here is that an ETF is just a wrapper. It's not a strategy. It's not a product per se. It's not active versus passive. It's not transparent versus non-transparent. The ETF is just a wrapper. It's a delivery mechanism to the end user. And in the instance of SMIG or any ETF for that matter, it's really important to understand the strategy. So when we're talking about different wrappers, right, a mutual fund, an SMA, a unit investment trust, or an ETF, it's important to understand the benefits of that wrapper, not necessarily the strategy, right? The strategy is one thing, the wrapper is the other. And the key talking point here is, the benefits of the ETF wrapper, right? The transparency. SMIG is a fully transparent ETF, just like you can log into almost every other ETF out there, and you can see your holdings on the website on a daily basis. It's low cost at 60 basis points. It is very attractive from an expense ratio standpoint. Number three, it's flexible. It's an ETF. So an ETF trades on an exchange. You have intraday liquidity. It's not like a mutual fund where you have to wait till the end of the day to execute, buy or sell shares. You can trade these ETFs on an exchange intraday. And most importantly is the tax benefits. The ETF wrapper is known for its tax efficiency because of the custom in-kind redemption process, which allows us to mitigate, essentially defer capital gains distributions down the road. And what this allows is the end user, the holder of the ETF, to actually determine when they want to realize these gains by selling the security, rather than in the mutual fund instance, receiving a capital gains distribution potentially on an annual basis. So again, it's really about understanding the delivery mechanism. In this instance, it's the tax efficient ETF, and that is where we have launched the SMIG strategy. Regarding the strategy, again, this is a strategy, it could be deployed, and it is deployed in other wrappers as well. But for this strategy, we have it offered in a ETF wrapper.
Well, we're still in an income-starved environment. More investors are looking for alternatives. For example, preferred securities like AAM, low duration preferred and income securities, EDF, PFLD. What are your thoughts on this? And tell us a little bit about why investors would like to take a look at this.
Yeah, so before we dive into PFLD and the benefits of the strategy and the wrapper per se, let's take a step back and talk about preferreds, because as you mentioned, preferreds and other hybrid securities, they are often overlooked by investors, and unfortunately, given their potential benefits, they shouldn't be. So before we go into PFLD, let's talk about preferreds, right? What are they? Preferreds are generally, they're hybrid securities, right? So they're sort of a cross between stocks and bonds. And there's really three big talking points about preferreds when it comes to their benefits. Number one is they generally pay a higher yield than similarly rated bonds due to where they fall in the capital structure, capital stack, right? And number two is that preferred securities tend to offer tax efficient yield, right? And this is because many preferreds pay qualified dividends, so QDI, and which is taxed at a much lower rate than ordinary income. And then third is that preferreds and hybrid securities, they have low correlation or have historical low correlation to other asset classes like stocks and bonds. So if you think about it, in summary, you have higher yields, you have tax efficient income, and you have diversification, right? And I think these are all, these three benefits almost all investors could get on board with. So let's dive into PFLD and really sort of separate it from the pack, if you will. Now, there's currently 18 preferred ETFs out there in the marketplace, and they account for about $46 to $47 billion in assets. But PFLD is the only one that is specifically focused on low duration preferreds. And you may ask, well, why is this important? And this is important because, number one, if you have a lower duration, you're going to potentially have less interest rate sensitivity, and therefore potentially less volatility and potentially less riskier of a product. And this is really important in this current environment that we are today, because we hear all the time from investors, I'm starved for income, but on the same time, I'm also worried about the potential impact of rising rates. And with that said, we introduce PFLD and say, well, the SEC yield on the strategy right now, as of 8/30, was 5.16, and it has an effective duration of less than 1. And all of a sudden, their eyes sort of perk up, and they sort of put this look on their face, and they ask, how can you do this? And how are you achieving this? And when we walk them through the strategy, we're starting with one of the largest, broadest starting universes in terms of $25 exchange traded preferreds. And all we're doing is we're essentially compressing the holdings into the securities that have an effective duration of 1, less than 5, and that are trading at no more than 105% of par value. And by doing this, what we do is we're essentially providing you a sliver of the exchange-listed preferred market that has, minimal duration risk. So you're achieving a 5.16% SEC yield with a duration of less than 1. And that's what really makes PFLD very, very attractive in this given time. And as you mentioned, I am happy to report that we just cracked the $75 million mark with PFLD, and the momentum is continuing to grow. So thanks on that front.
All right, Lance, before we let you go, last question. Foreign stocks have underperformed relatively to U.S. stocks of late. AAM offers exposure to foreign stocks with ETF ticker symbols DMDV and EEMD. How do these two ETFs approach the way that they invest in foreign stocks?
So both of these products are part of our high dividend value ETF suite, and it also includes SPDV, which is our S&P 500 product as well. And really what these products are looking to do and what they achieve is to find or identify high dividend paying companies that are also generating a lot of cash flow. And the reason why we're doing this is obviously to achieve a higher level of current income. Right now, as of 8/31, the SEC yields on DMDV and EEMD were 4.70 and 5.45 respectively. So you're getting a nice uptick in current income. But we understand the importance of finding quality dividends, finding companies that have constant, continuous cash flow where they can support those dividends, and not only just support the dividends, but grow those dividends over time. And when you think about the emerging markets and international space right now, it's certainly an area that's been beaten down. And at AAM, we are a firm believer that it is time in the market is more important than timing the market. And with that said, we think products like these, DMDV and EEMD, allow you to get exposure into the international markets through a very efficient, tax-efficient, flexible wrapper like an ETF, which is also low cost. And it can provide you a relatively concentrated portfolio between 50 and 55 names that has sector diversification, that is identifying companies that not only pay a high dividend, but also have high cash flow. And by the way, they also pay monthly distributions as well. So the shareholder has the ability to compound those dividends over time by reinvesting those dividends back into the strategy, to the fund, or accumulating that income as it comes in on a monthly basis and meeting their needs. So again, at AAM, we really do think it's more time in the market than timing the market. And with that said, we do think it's a great time to sort of position into beaten down areas of the market like emerging markets and developed markets.
Lance, as usual, great stuff. Thanks for stopping by and sharing your insights. We can't wait to see you again.
Thanks for having me, Katie.
Be sure to visit aamlive.com to learn more about the ETF lineup at Advisors Asset Management. The link is posted in the description section below. And don't forget to subscribe to ETF Guide TV. Tell us how you're enjoying our timely programs like this one, along with those ETF battles and many others. And you can also find us on Twitter at ETF Guide. I'm Katy Temple, everyone. Thanks so much for watching. We'll see you soon.